Good evening, everybody. Welcome to our YouTube channel, Fast CPA and Consultants. I'd like to introduce our CPA, Fulton Abraham Sanchez. Welcome, Fulton.
Thank you, Sarah.
If you're visiting for the first time, a few months ago, we started this series Tax Talk, where you send us your question through email, social media. We'll group them up, and we have today's topics: tax requirement to open an LLC in the USA as a foreigner. So are we ready to begin, Fulton?
Yes, shoot me.
Awesome. So first question, what's the difference between tax reports between LLCs of one owner and LLCs with two or more partners?
Okay. For the IRS, for the Internal Revenue Service, and for the courts in the USA, there is a different treatment of limited liability company or limited liability companies with one member and with two or more members. For the first case, companies with LLC companies or limited liability companies with one member are for the Internal Revenue Service in the USA. The IRS is the LLC with one member is a disregarded entity. It means that the company for the IRS does not exist. Therefore, the owner of the company is the one responsible for the reporting of the profits of the company, income and expenses that create the profit. Now, for a foreigner, that creates a problem because to report taxes at the personal level that the IRS requires for an LLC that has one single member, the owner of that LLC, the single member, the only owner of the LLC, the IRS requires for him or her to apply for a tax ID. And that is what is called an individual tax identification number, that whenever the foreign individual, the foreign owner of the company, is going to pay taxes for the profits of the LLC that he owns singly, the owner needs to apply for this number together or in conjunction with the filing of the tax return. So there are two types of forms. Whenever the owner of the company, the single member of the LLC, will file taxes, he or she has to apply for a individual tax identification number. And in addition to that, or with that, the owner of the company LLC will need to pay taxes. We need to file a tax return informing the income and expenses of the company into one scale, personal scale, and then paying taxes for that. That is the main difference between an LLC with one member and an LLC with many members. Now, this is for LLC with one member. For LLC with many members, two or more, things are different. Not that much, but they are, because in that case, the LLC with two members needs to file a tax return by itself. In the previous case, as we said before, LLC with one member, the company does not file a tax return by itself. It is the owner that files. And for the IRS, that is known as a disregarded entity. In this case, the IRS does require a tax return. So it's not a disregarded entity anymore. An LLC with two members must file a tax return, but will pay no tax. The LLC with two members or more will give to the members a document with the profits of the company according to the percentage that they own. And with that paper, the individual owner, the owner, 2 or 3, 4, 5 owners will go and apply and pay taxes. If they are foreign citizens, not residents in the US, they will need, each one will need to file for an individual tax identification number. And with that, repeat the process that we mentioned before for the single owner. They have to file an application for requesting a tax ID, an individual tax identification number. And second, they need to file a tax return to pay the taxes, informing the income and expenses of the, informing only the profits of the company. In this case, they will not inform income expenses because the company already filed a tax return. It is only the profits according to the percentage of their ownership that they will file and pay taxes for, but they still need to apply for a tax ID. Now, this is in terms of IRS treatment. At the level of the court, legally, an LLC with one member does not exist. Therefore, there is no privilege of the limited liability, because this is the objective of the limited liability company. The objective of limited liability company is to enjoy the privilege of limited liability in case of anything happens with the business that the company is doing, and anyone bringing a lawsuit against the company, only the investment in the company, the owners will lose. But because there is an LLC with one single member, that privilege does not apply. So for the courts, the LLC with one member is also a disregarded entity, meaning that it is like it does not exist. The same thing as with the IRS. So the IRS considers an LLC with one member disregarded entity. It does not exist. The courts consider the same. The LLC with one member for the courts does not exist. It is the owner that assumes the responsibility, and that's a problem because now the owner, the personal assets of the owner, will be responsible for any lawsuit if the assets of the company are not enough to cover the lawsuit that the other person is bringing. Things change when the LLC has two or more members. When there are two or more members, the IRS and the courts here in the United States consider the LLC as a company itself separated from the owner. Therefore, anyone bringing a lawsuit against the company, an LLC with two members, a limited liability company with two members, the company, the only risk that the company has, that the owners will have for that company, is the investment that they have in the company. And if there is a lawsuit that is bringing against the company, it is only the assets of the company that will be compromised, but not the assets of each one of the individual owners. That's the main difference between one LLC with one member and one LLC with two or more members.
Okay, awesome. Okay, so question number 2. What requirements must be taken into account to file tax reports for LLC with foreign owners?
Okay, for an LLC with foreign owners, there is an additional obligation related or compared to the ones with U.S. resident owners. An LLC with a regular LLC with two or more owners will need to file a tax return at the end of the year with the IRS. The tax return will include the income and expenses of the company, the calculation of the profits, and based on that, will create one sheet that will be given to every owner of the company according to the percentage that they own in the company, and that percentage will distribute the profits of the company. So if there is $100,000 and there are two owners, 50 and 50, each one will receive a document that is called a K-1 with $50,000 to report in their individual tax returns. That's a process. Well, then later the individual owner will go and file its personal tax return, and with that document will include the K-1 will be included in the tax return to pay taxes with any other income they have, for example, salaries, pensions, distributions, whatever they might have, interest. But once that is completed, there is one more step, one additional level of reporting for LLCs or limited liability companies with foreign owners. The limited liability company with foreign owners is required to withhold every quarter 35% of the profits that corresponds to that particular foreign owner. So if the company has two owners and through the year, in the first quarter, the company makes $20,000. The two owners, one is US, one is not. Then the first quarter $20,000 profit, it is divided into two, so 10,000 and 10,000 for each of the owners. There's one owner who is a foreign citizen. Out of those $10,000, the partnership will need to withhold $3,500 to give it to the IRS. And this happens every single quarter. At the end of the year, the foreign owner will file a tax return, will apply for an ITIN, an individual tax identification number, will file a tax return, and if that is the only income he or she has, he will have to require a refund. If the owner of the company, the foreign owner of the company, shows more income, probably he will receive no refund in that case. But this is how it works, and this is many, and this is the problem. Many times foreign owners are advised, just open an LLC, but there are consequences. There are tax consequences that they are not informed. They are not aware because they are not in the US. And usually people who open companies, they are not CPAs, they are not tax specialists. They don't know the tax consequences of opening an LLC for a foreign owner. So it's very important that every foreign owner knows about this and he is aware, and the company also is aware that there is this withholding for the profits of each one of the foreign owners, and the partnership is in the obligation to report, to send this money to the IRS. Otherwise, it can be penalized from the IRS.
Okay, so question number 3, what is the best tax strategy to carry out international operations of an LLC located in the USA?
What I've seen from many clients is that there is, in the United States, there is, for example, there is states like Delaware, Nevada, Wyoming that do not charge income tax to companies. But that only works, for example, when the business is not located or there is no sources of income that are within the USA. So there is one company that comes to Delaware and opens an LLC, but the business of the company is not in the US, but it's international. If the owner of the company is one single individual and that individual is foreign, there is no tax due because the sources of the income is foreign. And the only way that someone pays taxes in the US is when the income is sourced in the United States. Therefore, foreign individuals coming to the United States, opening a company in Delaware, and the sources of their income is not in the United States, but they are foreign, they will pay no tax when the company is one single individual. Now, things change when the company is 2 or more individuals. Mm-hmm. When the company is 2 or more individuals, even though the sources of the income are foreign, they have to pay taxes in the United States because it's 2 or more people. That's a main difference in terms of taxation. This only works when there are no assets in the United States. There is no assets producing income in the USA. Mm-hmm. There is no sources of income in the USA. And the company is owned by one single individual. Okay. If that single individual starts selling something in the US and he or she has clients in the United States, he has to pay taxes for those sales, mm-hmm. for the profit that he makes on those sales. Okay. The rule does not apply if there is activity in the USA for single owners. And the rule does not apply if the company has 2 or more owners. That is perhaps one of the benefits of having a company in these states, in Delaware, that they do not, Delaware, Wyoming, Nevada, that these states do not tax profits of companies. And because the LLC, the limited liability company, is owned by a foreign individual, at the federal level, there is no tax either because there is no income source in the United States. But remember, things change if you have assets in the US. If you have a house and you rent out the house and they produce income, then you have to pay taxes for that income, even though you are not living in the US and you are a foreign citizen. So things change. The key of this state or the reason why this work is the non-existence of income or sources of income in the USA.
Okay. So next we have, which states provide better tax benefits for an LLC in the USA? What are the main differences?
As I said before, the states that are better suited for individuals are Wyoming, Delaware. Delaware is perhaps one of the most famous and is even considered offshore. But the reason it's considered offshore is because it keeps the confidentiality of the individuals, meaning that in the rest of the states, all the names of the owners of the companies are public. In Wyoming, Nevada, in Delaware, Wyoming, and Nevada, they are not. It is only the names of the company and the date of the recording, the date of opening of the company, incorporation or formation, but there is no revelation of the names of the company. So they are considered offshore in the sense that they are the secrecy of the information. But if you want to open a company, come to the US and open a company, it does not depend of Delaware, Wyoming, or Nevada, because remember, even though you open a company in any of these states, and the business is located in Florida or in Texas, you will need to also register the company that you open in Delaware. You need to also register the company in Florida or in Texas, because in the United States, companies are not at the federal level. They are not national. They are by state. They are the state. Each state is the one in charge of legislating the company law, the limited liability companies, corporations, companies in general. So a company open in Florida cannot do business in Delaware, or a company open in Delaware cannot do business in Florida. A company open in Florida, a company open in Delaware will not be able to do business in Texas unless it registers in that state. It's like doing a second formation of the company there. Therefore, the states that give you the best tax treatment if there is a foreign citizen are the ones that I mentioned before. Is Delaware, Wyoming, and Nevada. But if the individual owns or comes to buy a property in Florida, buy a property in Texas, he or she will need to register the company that they open in Texas and in Delaware. Will need to register the company open in Delaware, also in Texas, because whenever he is going to buy the property, the state of Texas will require a company in Texas, or that he put the company at his name. Same thing happens with a business. If, for example, the foreign owner opens a company in Delaware and he or she starts selling in Amazon things, and the sales are done within the USA, he will probably be able to stay in Delaware, but he will need to pay taxes because he's making money in the United States. So it all depends on the structure of the business. If the business is entirely international and the sources of income are not in the US, and you are a foreign citizen and you have one company and you are the only owner, it's good for you to have an LLC in Delaware, Wyoming, or Nevada for that purpose. But remember, you need to have your business needs to be outside of the US. The moment that you have assets in the US and those assets produce income, this could be a property, this could be a business, you have to pay taxes in the United States. And if that business or that property is not located in Delaware or Wyoming or Nevada, where you open the company, you need to register the company in each of these states as well. And some states will charge also income tax in addition to the income tax of the IRS. So be very careful when you do your tax planning, because your position can be compromised, and if you are not well informed, you will believe that you are complying with the tax requirements in the United States, but that will not be the case.
Right. Okay, so next question we have, what is the maximum retention paid by an LLC in the USA? Explain the reasons.
This is related to the 35% withholding. The maximum retention for an LLC with a foreign owner is 35%. 35% of the profits of the profit that correspond to that individual. Remember, it's not 35% of sales. It's the withholding, meaning that the partnership, and this is only for two individuals. Remember, the 35% is for an LLC with two or more partners. When an LLC has two or more partners, and there is one foreign owner or two foreign owners, or all of them are foreign owners, the LLC, the limited liability company, is required to withhold 35% of the profits, not the sales, but the profits, not the revenues, the profit. Sales minus expenses equals profit. So out of those profits, if there is one partner, if the company has two or more partners, and there is one of them who is a foreign citizen, or all of them are foreign citizens, each one will need, there is a 35% withholding of the profits, and those profits are given to the IRS. At the end of the year, the foreign partner or the foreign partners will file a tax return, apply for a tax ID, and they will claim a refund if that is the case.
Okay, so we have the next one. In what scenarios does the IRS return their withholding, and what is the percentage of that return?
In most scenarios, the IRS will return the money minus the taxes that are owed. Here in the United States, LLCs do not pay taxes. Remember, we said that at the beginning. It is the owners who pay taxes at the individual level. So there is an LLC with two owners, as the example as before. Each one will receive the profits of the company is $100,000. There are two owners, each one owns 50%. They will receive $50,000 each. $100,000 profits, 50% each. They will receive $50,000. This divided into each of them. Now, with that money, they will go and file a federal income tax return, personal income tax return, and on that, with those $50,000, they will be subject to the personal income tax rate. Personal income tax rate vary from 10% through 35%. The larger the income, the higher the percentage. But it does not mean that if, for example, if at 10, 12%, if at 12%, say 12, 20, if at 20%, for example, if you make $50,000, and just to give you an example, $50,000, that's what you receive from the LLC, and the percentages for $50,000 is 18% or 17%. You are not going to pay 17% over the 50, because the escalation rate of the taxes either start at 10%. So for the first portion, from zero to, if you're a single, from 0 to 10% to $10,000, you will pay 10%. From 10,000 to 40,000, you will pay 15%. From 40,000 to 80,000, you will pay 25%. So it goes by tranches. The higher the income, the larger the tax.
Okay.
Okay, so the higher the income, the larger the tax return, or the larger the larger the income, the higher the tax rate. And the tax rate there is classified by single and married filing jointly. So singles are higher tax rate, and married couples are lower tax rate. So for I'm doing this in example of a single, because any foreign citizen who is not living in the United States, it will always be classified as a single individual. So for singles, from $0 to $10,000, the tax rate is 10%. From $10,000 to 40,000 is 15%. From 40,000 to 80,000 is 25%. So each of the tranches of those $50,000 will be taxed at a specific tax level. So the first 10,000 and 10%, the second 50, the second from 10 to 40 at 15%, and the last portion from 40 to 50 will be taxed at 25%. So those are the rates that are inputted for each of the tranches of those $50,000. That's how taxes are calculated in the United States. So if there is out of the $50,000, there is a 30% withholding is 15,000. I'm sorry, 15,000. So 15,000. If those 15,000 are are higher than the calculation of the taxes, 10% for 10,000, 15% from 20 to 40, and then 25% from 40 to 50. If that calculation is lower than the $15,000 that are withheld, the IRS will give the refund to the person. But if the foreign owner has other income in the USA, in addition to the profits from that company, the refund will be lower. And if he has significant income, probably the refund will be zero. That's how taxes are calculated here. So again, if out of the $50,000 in a year, there is taxes already paid to the IRS, remember that the owner, the IRS will, the LLC will need to withhold 35% of that money that is given to the foreign partners. So if there is $100,000 in a company, LLC, that is distributed to people, same example I had before, 35% over 100%, $100,000 is 35,000. So $35,000 for divided into two, there's two partners. 35% of our $100,000, $35,000 divided into two is 17,500. So $17,500 from one partner paid to the IRS, 17,500 for the other partner paid to the IRS. That money is given to the IRS through the year. So at the end of the year, those taxes are paid. If I am the partner, foreign partner, the partnership will give me two papers. Will give me a paper with $50,000 of profit that corresponds to me, and will give me another paper for $17,500 taxes paid. So I take those two papers, I file my income tax return, I file a request for a tax ID, and then the IRS has to give me back the money. But that happens at the end of the year. If that's my only income, remember, the IRS is not going to give me $17,500. The full amount that was withheld was not going to give me, because I have to pay some taxes. It's going to give me the amount withheld minus the taxes over the $50,000, calculated at 10% for the first 10,000, that will be 1,000, 15% for the second from 20 to 40. So that will be 20 more at 15, it will be $3,000 more. So it will be 4,500. And then finally, 25% over the portion between 40 and 50, that will be 10,000, $2,500 more dollars. So that will be $5,000 that I have to pay. So the $50,000, according to the rates, will mean $5,000 in taxes. As the partner, as the LLC, the limited liability company, withheld $17,500, the IRS will give me $12,500 as a refund. That's how things work with the IRS.
Got it. So for our last question, we have, what advantages of an LLC when the partners receive earnings of more than 100K per year?
Yeah, if they receive 100, and this is a good example, that it's good that I didn't see this question at the last one, but it's good that I use the $100,000 because I can continue with the $100,000 example. So if the $100,000 are, if there are more than $100,000 in profits and there are two partners, remember, if there is $150,000 of profits and there are two partners and the two partners are foreigners, then it will not be any more 50,000 for each. And the tax paid, it will not be 5,000, and the withholding will not be 17,500. It will be more withholding. In that case, $50,000, 35% is like 15, so it will be like almost $8,000 more in withholding. So instead of withholding 17,500, it will be withheld almost $25,000 in withholdings, and the taxes will probably be $7,500 or $8,000 more. So and this is the more profit the company is given to the owners, the higher the tax rate and the larger the taxes to be paid. There is the only advantage that the LLC will provide to foreign partners or foreign owners who make $100,000 or more is that the tax rates are escalating, meaning that you will only pay 10% over the 10,000, and the first 10,000 you will pay 15% over the next from 10 to 40, the next 30, and then the next 10, it will be paid 25%. And then if we go, no, then it will because it is 50 to 105, so it will still be there in that range. But this it is beneficial because if we compare this to a corporation, corporations pay 21% in taxes flat, and the corporation is the one paying that. Corporation is a different type of entity, different to the limited liability company. So there is a different tax rate, it's 21%, and in addition, the owners, when they receive dividends, they will need to pay an additional 15% of taxes. So it's like 35%. 35%, is almost flat. So the advantage for foreigners, for foreign citizens to come to the United States to do business is to open a limited liability company because of the graduated, the escalation, like the graduated rates for each one of the tranches of the income that they will receive.
Awesome. Okay, so that was our last question for today. Thank you, Fulton, for your time and for your information. Thank you all for joining us. If you have any more questions, you can send them to our email, social media. We do have an exclusive group on Facebook. We'll leave you the link down below. Remember to subscribe, and we'll see you on the next video. Thank you.
Thank you.